In March 2023, a bank that had survived two world wars and operated for 167 years was sold over a single weekend. The price was $3 billion, less than the cost of its Zurich headquarters. At its peak, Credit Suisse had been worth more than $300 billion. But the weekend wasn't the collapse. It was the moment the world realized the collapse had already happened. Credit Suisse had been dying for years, scandal by scandal, loss by loss, leadership failure by leadership failure, each one survivable on its own. Together, they were terminal. This is the story of how 167 years of institutional trust were compounded into nothing. Alfred Escher founded Credit Suisse in 1856 to finance Switzerland's railways. The bank underwrote the Gotthard Tunnel, connected the country to Europe, and wired itself into the economic identity of the nation. For over a century, Credit Suisse wasn't just a bank, it was part of what Switzerland meant. By the late 20th century, it had grown far beyond railways. A merger with First Boston, an $11 billion acquisition on Wall Street. Credit Suisse became a global investment bank, a Swiss institution playing an American game. And that transformation is where the decay began. The institution built on prudence started rewarding risk. The bank that had financed tunnels started chasing yield. The first major signal was Mozambique. In 2013, Credit Suisse arranged over $600 million in loans to Mozambique. The stated purpose was commercial tuna fishing. The actual result was one of the most damaging sovereign debt scandals in modern history. The loans were backed by illegal government guarantees never disclosed to Parliament. The money was embezzled. Credit Suisse bankers received millions in kickbacks. When Mozambique defaulted in 2016, the IMF and World Bank froze support to one of the poorest nations on earth. 3 bankers pleaded guilty to conspiracy charges. The bank paid over $500 million in fines. But this wasn't a rogue trader. This was a business unit operating with impunity, generating fees from a deal that any serious compliance function would have killed on sight. No one at the top was held responsible. This wasn't a rogue deal. It was a preview. Under CEO Brady Dougan, who led the bank from 2007 to 2015, Credit Suisse developed the culture that would ultimately destroy it. Dougan received 160 million Swiss francs in compensation. Over the same period, Credit Suisse shares lost 70% of their value. Risk management was underfunded. Compliance was treated as a cost center. When Dougan left, the bank appeared intact. The rot was already deep. It just hadn't surfaced yet. His replacement, Tidjane Thiam, was supposed to be the reformer, a mandate to pivot away from investment banking and toward wealth management. On paper, the strategy made sense. In practice, it was overtaken by something far more absurd. In September 2019, Credit Suisse's former wealth management chief, Iqbal Khan, was physically followed through the streets of Zurich by private investigators. Khan had left to join UBS, and someone inside the bank wanted to know if he was poaching clients. The surveillance was amateurish. Khan noticed, confronted the investigators, and the story went public. The bank's chief operating officer resigned. A private investigator involved died by suicide. And Thiam, despite being cleared of direct involvement, was forced out in February 2020. The spying scandal didn't cost billions. What it destroyed was harder to quantify. The sense that anyone at the top was focused on managing the institution rather than protecting their own position. Thomas Gottstein, a 20-year Credit Suisse veteran, replaced Thiam. He inherited a bank that was already wounded. Within a year, he would oversee 2 of the largest risk management failures in modern banking, in the same month. In March 2021, Greensill Capital collapsed. Credit Suisse had built $10 billion in supply chain finance funds around Greensill, but let Greensill itself select the assets. The bank never properly vetted what it was selling to its wealthiest clients. When Greensill imploded, the Swiss regulator found that Credit Suisse had seriously breached its supervisory obligations. $10 billion, managed with the due diligence of a handshake. This wasn't misjudgment, it was a pattern. Then, before the Greensill fallout had even been assessed, Archegos blew up. Archegos was a family office run by Bill Huang, who had previously pleaded guilty to insider trading. Huang built enormous concentrated stock positions, hiding their true size from the banks that financed them. When those positions reversed, Archegos defaulted on its margin calls. Goldman Sachs and Morgan Stanley moved fast, dumping their exposure within days. Credit Suisse hesitated. That hesitation cost them $5.5 billion. An independent review found that senior managers had been warned and persistently failed to act. The report called it a fundamental failure of management and controls. $5.5 billion lost, not because the risk was invisible, but because the people responsible for managing it chose not to look. The risk wasn't invisible, it was ignored. By now, the pattern was unmistakable. Mozambique, the spying scandal, Greensill, Archegos. Each crisis different in its specifics, each one revealing the same disease, an institution where risk was everyone's problem and no one's responsibility. Then came the Suisse Secrets. In February 2022, journalists from 48 media outlets published the largest leak in Swiss banking history. Over 100 billion Swiss francs across 30,000 accounts linked to human rights abusers, money launderers, and politically exposed individuals worldwide. The Suisse Secrets didn't reveal a new scandal. They revealed a pattern. Decades of willingness to hold money that any functioning compliance system should have rejected. The bank's own history had become the accusation. The final act began in October 2022. Not with a scandal, but with a whisper. Rumors spread on social media that Credit Suisse was on the verge of collapse. The claims were exaggerated, but they landed on a bank that had spent years exhausting every reserve of credibility it had. The result was a modern bank run. Not lines around the block, but wire transfers executed in seconds. In the fourth quarter of 2022, clients withdrew 110 billion Swiss francs. Two-thirds of the outflows happened in October alone. Credit Suisse's new CEO, the fourth in 8 years, announced a radical restructuring. The market responded with indifference. Then, in March 2023, Silicon Valley Bank collapsed, and the contagion crossed the Atlantic. Over the weekend of March 18th and 19th, the Swiss government brokered the end. UBS would acquire Credit Suisse for 3 billion Swiss francs. The Swiss National Bank committed 100 billion in liquidity support. 16 billion in bondholders' claims were written down to zero, while shareholders at least received UBS stock. The normal hierarchy of who gets paid first was inverted. On June 12, 2023, UBS completed the acquisition. Credit Suisse ceased to exist. Credit Suisse didn't die from one wound. It died from a decade of them. Each scandal eroded a layer of trust. Each leadership failure compounded the one before it. Each regulatory finding went unheeded. The bank became an institution that could survive any individual crisis and was destroyed by the accumulation of all of them. This is what systemic fragility looks like. Not a sudden shock, but a slow depletion. An institution that appears stable from the outside, while every internal safeguard is quietly failing. Boards that rotate executives without changing culture. Regulators that issue findings no one acts on. Credit Suisse was not brought down by a single villain or a single mistake. It was brought down by a system that allowed small failures to compound, year after year, until the weight of them became unsurvivable. 167 years of trust, dissolved in a weekend. Not because the final weekend was extraordinary, but because every year before it made the ending inevitable.